John Hardy. I wonder if David or John could care to speculate on whether the effects of the comprehensive spending review will have any effect on the pension fund, given the possible reduction in numbers of employees and therefore contributing members, and this might also have an effect on an increase in the number of pensioners or deferred pensioners.
Thank you. Yeah.
I think I can answer part of that, and John will then comment upon the impact on investment strategy. In terms of sheer numbers, we expect, and we're realistic, that the main employers will be downsizing because of the cut in grant that the government announced yesterday. It's got to impact on headcount. It's got to therefore look for early retirements and redundancies. In terms of the pension fund, that means that we will be paying more pensions out to those new pensioners and receiving less in contributions. As John was saying earlier, that at the moment the fund is expected to be cash positive until around 2025. Cash positive means you're taking more in contributions than you're paying out in benefits. As that balance changes and we start paying more out and taking less in, then the impact is that the deficit at each valuation grows because we're not holding as much assets in order to meet the pension promise. And two impacts on that. One is that at the moment, under the current regime, employers would have to pay more in. Post-Hutton, it may be that some of that risk is put onto the employee contributors, and the contributors have to put more in, the ones who are left behind with a job. That's the numbers, but it also has an impact on how the fund is invested. And I think that's for John to answer back for you.
Yes. Ironically, you can look at this in two ways. Because we theoretically will be more mature, as Dave said, we'll be paying out more money to more people, you would logically expect us to start investing in bonds because that is the safer way of doing it. However, because you are reducing the amount of incoming cash, you've got less to play with in order to try and recoup the deficit. So you become, or you should be thinking about becoming more aggressive with how you invest the money. So on the one hand, you want to be more safe, and on the other hand, you want to be more aggressive. And therefore, what will probably occur is that we will skew the asset mix to a slightly higher allocation to bonds, but not necessarily index-linked bonds, but bonds which provide better yield returns. And within the performance part of the fund, increase our allocation to things like alternatives, become a bit more overseas orientated in our equity allocation, which is where we think the longer term growth is going to come from. We may consciously increase our requirement for yield by going out to companies with strong dividend growth. So there are ways of adjusting that. And that is part of the process which councillors will be considering during November and December in accord with our independent advisors. It is a bit of a quandary, and it is tempting to react too early. I think we need to see how things settle down because we don't actually know over what time scale the change will come in.
I mean, the only thing I would like to add to that in the sense of one of the drivers for the comprehensive spending review for the Chancellor was the health of UK PLC. And if you look at our investment portfolio, clearly South Yorkshire Pension Authority is very much invested in UK PLC, and so the strength of the UK equity market and the strength of that, the corporate bonds that we have are also part of the reason for some of the Chancellor's decisions. So the statement yesterday had many potential impacts on the pension fund, and I think what we're saying is that some of those pull in different directions, and it's very early to say. But I mean, it clearly was a very important budget statement, and it will have impacts over the next 4 or 5 years.
I mean, at a more practical level as well, I think one of the other concerns we've got arising from yesterday is that the extent to which the cuts that local authorities are going to have to be made fall in the areas on the support staff, which is, I mean, and obviously council are going to want to maintain the frontline services, and the impact could well fall on the support staff who are the sort of the channels of the information we got. With 120,000 people in our fund either paying in or drawing out, it survives on having correct information, prompting to the information, that sort of thing. So we do have some concerns that, you know, some of the employees may have to cut back on support staff, and that might actually reduce, you know, the flow of information. But that remains to be seen. I think I've got the gentleman at the end there, and then the lady next to him. I think, yeah, thank you.
This is for John. We've got index-linked bonds 11%, other bonds 12%. What are other bonds?
Primarily bonds issued by companies, what we call corporate bonds. Corporate bonds, because the companies can go bust, tend to pay a higher interest return or coupon return than government bonds. So there's a yield attraction. The problem is that if you pick the wrong company, then you lose your capital because the bond goes bust. So the art of analysing a corporate bond is to try and estimate the risk of default on that bond and whether you are being paid enough in terms of additional income to justify that risk. Now, there are stages of the economic cycle when markets go a bit mad and don't price things correctly. And 2 or 3 years ago, you could pick up some really good quality company bonds at what looked very cheap valuations. And that is when we put a lot of money into the corporate bond market. As markets has recovered and the financial conditions are beginning to stabilise, those bonds are beginning to look less attractive because market values have gone up. Similarly, the default risk has not been as high as markets feared. Fewer companies have actually gone bust than markets were penciling in. So your premiums you're now you could buy these vehicles at is less than it was. So the corporate bond portfolio, in simple terms, is more risky than government bonds that actually pays you more. So again, going back to a Tesco example, Tesco, when they go to the market to raise £200 million, will issue a bond. If the government gilt is at 1.25%, then Tesco could probably get away with paying 3.5%. So you're getting an additional yield because there is a risk that Tesco will go bust. But you are paying for that risk by actually having the idea that you may lose your capital.
Thank you.
Yeah, I think the lady next to all right.
Well, did you want one as well?
Yeah,
Okay.
yeah.
Oh, okay.
Okay.
I've not heard anything about gold. Now, what are the advantages and disadvantages of gold? I mean, you have cash.
So I did hear, can people hear that? Questions about gold.
Yeah, could you hold the microphone a bit closer?
Oh,
Sorry. That's it. Yeah, lovely.
Is that better?
That's better, yeah.
We can hear, but they can't hear at the back.
Okay, gold. What are the advantages and disadvantages of buying gold and having that as an asset? I hear lots of people, run to buy gold. Do we have any?
Right. As David said, this is when I talk about the fact that under the FSA I'm not allowed to give independent financial advice. There are restrictions on what your fund can hold, and physical commodities is one of those restrictions. So we cannot buy gold bars. We cannot go out and buy jewellery either, or indeed invest in Lingfield Park. But how do we access the gold market? Gold is a very peculiar asset in that it has this intrinsic value which people ascribe to it. But it's actually a pretty useless metal. Apart from jewellery, there aren't many uses it can be put to. It's not like a rare earth or electronics or silver or platinum in catalytic converters and things. So gold is an intrinsic thing. Now, in times of stress, traditionally people went out and bought gold because it was acted as a safety net. And well, I won't make a political point, but when Gordon Brown sold off the UK gold reserves, he did it at a ridiculously low price, right? So now gold is rapidly getting close to the $2,000 an ounce level. That may be a bubble in itself, because bubbles burst. And what you're left with is a lump of shiny yellow metal, which if you like putting it in a window, that's fine. You can go and look at it and stroke it every now and then. But it hasn't really got any intrinsic value unless you can sell that bar to somebody else. So we don't physically hold gold. What we do invest in are mining companies which do invest in gold. Now, that is a slightly different story in that when gold prices were relatively low, people weren't putting their capital into mines. So all of a sudden it's become fashionable again and people want gold out of the ground, but the mines aren't there. They're not efficient enough. So the mining companies are running like heck to actually catch up and are putting money in. So gold shares shot up, but now plateauing out as that is becoming a bit more apparent. Like all commodities, there are bursts of enthusiasm when they get overate. Supply and demand, because of the lead time into developing a mine is anything up to 10 to 15 years. It's not something you can just switch a tap on and it comes out next week. I can't remember the numbers, but the amount of gold mined since the year dot is actually remarkably small. And you know, you could probably fill this room with it, and that's it. So it is a unique commodity. Commodities in general have gone up in price as the Chinese economy has evolved, because China has been taking a quite sensible policy decision from their point of view, that the more the world's assets they can secure, the better for them in the longer term. And therefore they have been buying mining assets around the world, and that has temporarily boosted a lot of commodity prices.
Thank you.
I think that's it, yeah.
Josie Whitehead, I'm retired ex-social services. I want to ask about AVCs. I lost a lot of money to Equitable Life, and it's reared its head again on the media this week, and it said that we're to register for it. Will the Pensions Authority send me the necessary documents?
We know about as much as you do, in that we've seen obviously the announcement at yesterday's spending review that the government intend to pay out $1.5 billion in compensation, which groups that compensation will be paid to, under what circumstances it will be paid, and in what timescale it will be paid. I have no more idea than you have. So until we get further details as to who is covered, who of our scheme members might be able to make a claim, if we can assist, then we will assist. But at this moment in time, we have not got a clue who's going to get paid, what they're going to get paid, and when.
But do you have records of how many people have got AVCs in Equity Life?
We have records maintained to the year dot that tells us who did pay
Who paid what,
into
where?
Equitable Life.
Yeah, because then it went to Scottish Widows, didn't it?
It's changed all over the
All
place.
over the place, yeah.
It was bought out by H-Boss, and then Prudential got involved, and somebody else bought a bit of Equitable Life and started buying their insurance, pension policies and things like that. But we just don't know the detail.
Thank you.
Okay, next questions? We've still got about 10 minutes before the pies arrive. A gentleman down there, thank you very much. Yeah.